Welcome to Lecture 13 of the IFRS 9 crash course. In this lecture, we'll look at the role of macroeconomic scenarios in calculating expected credit losses. IFRS 9 requires that credit loss provisions are forward-looking. This means banks must incorporate the impact of future economic conditions, not just rely on past data. To do this, institutions develop multiple macroeconomic scenarios. The standard approach is to create three scenarios. The base case represents the central forecast, often based on consensus or internal models. The upside scenario reflects better than expected conditions, such as stronger GDP growth and lower unemployment. The downside scenario represents adverse conditions, such as recession, rising unemployment, or falling house prices. Each scenario is assigned a probability weight. For example, a bank may assign 60% to the base case, 20% to the upside, and 20% to the downside. Expected credit losses are then calculated under each scenario and combined using the assigned weights. Let's work through an example. Suppose the base case ECL is £1,000, the upside ECL is £600, and the downside ECL is £2,000. With the given weights, the final provision is £1,120. This reflects a balanced view across possible futures, not just the most likely one. The benefit of using scenarios is that it captures the uncertainty of the future. It prevents provisions from being overly optimistic or pessimistic, and it ensures investors and regulators see a more complete picture of credit risk. To summarize, macroeconomic scenarios are a core feature of IFRS 9. They make provisions forward-looking, probability-weighted, and more reflective of real-world uncertainty. In the next lecture, we'll discuss management overlays, which are additional adjustments made on top of modeled ECL results.